Hello, I'm Hunsley from Livewire Markets, and this is The Pitch. Our subject today is the debate that probably keeps more than a few investors up at night. China versus India. On the one hand, you have a deep value play that now has a boost thanks to positive fiscal stimulus announcements. And on the other hand, you have a structural growth story, but the stock opportunities are just way too expensive. So which is the better play? Joining us to discuss is Andrew Swan, who runs the Man GLG Asia Opportunities Fund. Andrew, welcome.
Thank you very much.
So, as I mentioned there, China and India, two vastly divergent economies, but also two of the most consequential economies in Asia. But can you break down those markedly different trajectories for us?
Yeah, look, they're big economies that are at different stages of development. I think there's a cyclical element and there's a structural element. I think the long-term outlook for India, as we see it today, remains fairly healthy. I mean, we don't really see bubbles in the market, in the economy, I should say. But the economy has done well the last few years. Corporate profit growth has been strong. And that's occurring at a time when cyclically liquidity is slowing down a little bit. So it does, I think, pose some risk in the short term when you have high expectations, whether you talk about multiples or earnings expectations, at a time when liquidity in the economy is slowing down, because that tends to put pressure on corporate earnings. The flip side is, China is at the end of an economic model. Growth is slowing. We have deflation setting in, which is always bad for corporate profitability. And now we've seen, as a result of that, earnings expectations or corporate profits been under pressure, earnings expectations have been revised down, and the market trades very cheap to reflect those problems. So the key question is, can China do something both cyclically and structurally at this point in time to improve the outlook for both economic growth and corporate profit growth? And we do think China is on the verge of both we're seeing the cyclical enhancements coming, but also I think there's some really interesting structural stuff coming, which means the risk reward, I think, at the moment favours China over India.
With that said, although you may see India as slightly more unfavourable on a relative basis, are you still finding select opportunities in that market?
Yeah, look, I think, from a stock-specific point of view, there's still some really good, interesting companies in India. We do tend to find pretty high-quality companies up there. We do think the macro overall means a lower allocation today because of, risk to growth. But within that, there are some really interesting, higher growth stories, whether you talk about, healthcare companies, transport companies, consumer companies, even financial services firms. There's always opportunity inside that market.
Where are you finding idiosyncratic opportunities in China?
Well, the first step is, everything moves here because this is a very big liquidity injection that the government is promising, both monetary policy and fiscal policy. And I think it's important to recognise why it's happening now. The Chinese policymakers have prioritised currency stability above everything else this year. And the way you do that is by keeping real interest rates high relative to the currency or the country that you're trying to stabilise your currency against, and that being the US. Now, the problem for China is the US has a very different economic setup. They've got higher growth and high inflation and therefore tight monetary policy. But to keep the currency stable in China up until recently, they've had to run US monetary policy, even though their economic situation is the opposite. So really through the course of this year, the policymakers have been tightening policy, when in fact many people have been arguing they should be loosening, but that's because they've prioritised currency stability. Now, what has happened most recently is the Federal Reserve has started to cut interest rates, and that has put the power back in the hands of many central banks around the world, but in particular China. So it's no coincidence that China has eased monetary policy almost immediately after the US has started the same process. So that's on one hand. On the other hand, fiscal policy as well is been actually quite restrictive. Again, this is not well understood, but China's fiscal deficit has been contracting this year versus last year. So really you've had tight monetary policy and tight fiscal policy in a weak economy with deflationary forces. So, it's understandable why the market is so cheap and why it has performed so poorly and the economy's done so poorly. But we are now changing. Monetary policy has shifted and fiscal policy is about to shift. And then I think we move from cyclical policy to structural policy, which I think is also another leg that this market can potentially develop in the coming months.
Okay, so with that said then, let me follow you up on that. which sectors, which assets, which themes are most likely to benefit from those structural and cyclical tailwinds?
Ultimately, what we're talking about here is a shift in the economy from deflationary forces to reflationary forces by boosting demand in the economy. Now, obviously consumer benefits, and we're working through, if we get this boost, who benefits the most in the consumer space? But it really moves beyond that. It can impact financials positively, like housing and insurance stocks. It can also benefit industrial companies as they start to produce or increase their utilisation of their plant and get some pricing power, which is always good for profitability and share price performance.
All right, Andrew Swan, beautifully explained. Thanks for joining us there from ManGLG. And thank you for joining us for The Pitch. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where you can find more episodes of The Pitch. Till we see you next, take care.